So we are to start on F. You are meant to start on F. So you are to start on F. So E was the present value of the annuity in perpetuity, isn't it? Yeah, so we go to F. F should be present value of the growing annuity in perpetuity. So we go to F as present value of the growing annuity in perpetuity. The present value of the growing annuity in perpetuity. So we go to F as present value of the growing annuity in perpetuity. So under that, we can write something brief on that element, whereby we summarize that this is where the annuity is expected. It is where the annuity is expected to increase at a constant growth rate per annum until infinity. This is where the annuity is expected to increase at a constant growth rate per annum until infinity. It is where the annuity is expected to increase at a constant growth rate per annum until infinity. At a constant growth rate per annum until infinity. Its present value will be calculated as follows. Its present value will be calculated as follows. Its present value will be calculated as follows. So this is now how to get present value of the annuity, which is growing up to infinity. So present value for the annuity, which is growing up. This is present value for the annuity growing up to infinity. So it will be given by annuity in period 1, annuity in period 1, annuity in period 1. We divide by cost of capital, the cost of capital, minus constant growth rate. So it is supposed to be given by the annuity in period 1. We divide by cost of capital minus constant growth rate. So it is annuity in period 1. Then we divide by the cost of capital minus the constant growth rate. So it is the same as annuity in period 1. Cost of capital is R, growth rate is G, like that. So we finally express it as annuity in period 1 divided by R minus G. So R is the cost of capital, G is the constant growth rate. Then also, to get this annuity in period 1, we take annuity in period 0, also 1 plus G, like that. We divide by R minus G. So if you want to get the annuity in year 1, you simply take annuity in year 0, you increase it by the constant growth rate, G. So this is annuity in year 0, then 1 plus. So G is now the growth rate. We are simply increasing that annuity by the constant growth rate. So if I want to get the figure in year 1, I take the figure in the previous year. I increase it by the growth rate to get now the value for this year. So this will be the annuity in the previous year. The cash flows that was there last year, you increase it. So 1 plus G, G is the growth rate. We add the growth rate on what we had, then we get it. So R is the cost of capital, then it also minus G. So that's now how we shall be computing the present value of the growing annuity in perpetuity. So finally, we go to G. We can now have G. We we can now also have G. So G will be present value of the deferred annuity. The present value of the deferred or differential annuity. So we can also write something brief about present value of the deferred or differential annuity. The present value of the deferred or differential annuity. So when we mention about deferred or differential, it is cash flows which will remain the same, let's say for 3 years. Then it changed. After it changed, it also remained the same, maybe for another 4 years. Then again it changed, but as also it changed, it also remained the same for another given period of time. That's why we refer to it as deferred. So for that, you summarize that this is where cash flows will remain constant. It is where cash flows will remain constant for a given period of time. It is where the cash flows will remain constant for a given period of time. For a given period of time, and then it changed, and then it changed, and then it changed. However, after it changed, it also remains constant. However, after it changed, it also remained constant. It also remained constant for another given period of time. It also remained constant for another given period of time. It also remained constant for another given period of time. So I will give you now an illustration to justify the formulas I've given you. So let us write down an illustration of that. We can write an illustration by summarizing that. Consider a 5-year project. Consider a 5-year project which is expected to generate the following cash flows. Consider a 5-year project which is expected to generate the following cash flows. Consider a 5-year project which is expected to generate the following cash flows. So consider a 5-year project which is expected to generate the following cash flows. So we can summarize it this way. We can have the year and also the cash flows. Having the year and also so year 1, cash flows for year 1 will be 60,000. Then year 2 will be 50,000. Then year 3 will be 30,000. Year 4 will also be 30,000. Then so year 5, it will also be 30,000. We can be having the year 1 up to year 5, then cash flows year 1, 2, 3, 4 up to year 5. Year 1, 2, 3, 4 up to year 5. Then another paragraph we add there by noting that. We add there another paragraph by summarizing that. If the cost of capital is 12%, so another paragraph will note that if the cost of capital is 12%, if the cost of capital is 12%, determine the present value of these cash flows. If the cost of capital is 12%, determine the present value of these cash flows. If the cost of capital is 12%, determine the present value for these cash flows. So I want us now to see how to get the present value for this cash flow. So what you do, you will come up with the year, then also cash flows, then present value interest factor, 12% for each year, then also the present value for that. So I want us first to use the first table. Year 1, 2, 3, 4, up to year 5. So cash flows are 60,000, then 50,000, 30,000, also 30,000, also 13,000. So I have given you present value tables. Yeah. So I want us to get those tables so that we can apply them. Look what. So let me see that. So I want us to check the tables. I want us to get the tables. So those who are online, I hope you can still be able to access the present value tables. So I want us to go to that table. There are 2 of them, so we are using the first one. So you check up under 12%. You check under 12%. So when you check under 12%, then you move to period 1. So what figure can you be able to see under period 1? 0.89. So let me also have the one for year 2. The one for year 2, you can see which value in the table. 0.79. 72. How about year 3? 0.7. 118. How about year 4? So 0.6355. 0.6355. Then year 5 is which value? 0.5674. Yeah, so online, I hope you can see those figures in your table. So multiply this figure by this, you record there. You also multiply this one by that, you record there. You multiply this value by this, you get the value, also the value. Then you will add them together. You will then add them together to give us the present value for that period.
a customer is willing and able to pay in exchange for a product or a service. The amount of money that the customer is willing and able to pay in exchange for product or service. Price is also the amount of money that a seller is willing to accept in order to exchange that is how we define price. And as you know, there are many ones that pricing depending on the cost. There are school like this, price going and fees. The price going go to a water or a company, they are pricing going you go to work, for whatever reason, you have paid something, that price is called a fine. Maybe other, you have rented a house with someone, or even that, the price we charge is called a rent. So there are many words that are used to describe that amount.
So when you add, you are getting a total of 158, 158.70, 875. Yeah, so it is rounding off. So after that, because year 3 up to year 5, the cash flows are the same. So you see the amount are the same. So it is always better to use the second table. But what I want you to do first, add for me the last 3 separately and get the figure. Add the last 3 separately and get the value. So just add the last 3 separately and get the value. Just add the last 3 separately, then you get the figure. So online you participate, you also give me your figures so that I can see whether we are moving at the same pace. So the last 3 is 57. Yeah, so I can see people are getting 57,441. So when cash flows are the same, we are normally advised to use the second table. So I want to show you how to use the second table and get the same figure. I want to show you how to use the second table and get the same value. So this year 3 up to year 5, year 3 up to year 5, those cash flows are the same. So alternatively, year 3 up to year 5, we should be able to use the second table. When you use the second table, when cash flows are the same, we refer to them as annuity. When cash flows are the same, we refer to them as annuity. So we take present value interest factor for the annuity, 12% in year 5. Then I subtract present value interest factor for the annuity, 12% in year 2. Because I want to get the one from year 3 up to year 5. So I take the one for year 5, I minus the one for year 2. Because that second table is accumulated total of the first table. You see that first table? When you go to the second table, the figures you get in the second table is accumulated total of the first table. So if I want to get between year 3 and year 5, I take the one for year 5, I minus the one for year 2. So my annuity is 30,000. So I want you to check for me. Check for me that second table. Check 12% in year 5. Check in the other table. What is there as 12% in year 5? What is there as 12% in year 5? 3.30. 3.30 or 3.60. 3.6048. Then also confirm the one for year 2, still in the same table. Also confirm the one for year 2 in the same table. It is 1.690. So confirm that and see it will give you which figure. I want you to confirm that value and see. It will be able to give you which value. So confirm and see. It will give you which value. The same figure calculator. Yeah, so when you can still use the second table instead of the first table, when the cash flows are the same, you apply the second table. Because the second table is accumulated total for the first table. So online, is it clear at that level? Online, are you able now to see this information? Are you okay with the information you have just seen? Yeah, so when cash flows are the same, you are advised to use the second table for a given range. You see the other one I arranged year 3 separately, year 4 separately, and the year 5 separately. So what you do, you just take one annuity, the 30,000, then you check in the second table 12% in year 5, then also 12% in year 2. The difference that you get is the same as the total that was there in the first table for year 3, year 4, and year 5. Then you now multiply by only 30,000 among the 3 of them. But we shall be learning more as we do other questions. We shall learn more as we do other questions, because this figure that you are getting is the same as the total you got when you add it for the 3 reasons. Yeah, so we can still learn how to use now the second table. When cash flows will be the same, I will be advising you to use the second table, and I will show you more on how to follow the same order. So now, apart from that, I want to give you another illustration. To see how to get the same. So another illustration, we can write that consider a project. Consider a project which is expected. Consider a project which is expected to generate the following cash flows. Consider a project which is expected to generate the following cash flows. Which is expected to generate the following cash flows. Which is expected to generate the following cash flows. Which is expected to generate the following cash flows. So we can be able to have the year and also the cash flows. So from year 1 up to year 4, it is 30,000. Also from year 5 up to year 9, we should be able to have it as 50,000. Then also from year 10 up to infinity, we shall be able to have it as 20,000. we can add there a paragraph that we can now add there a paragraph that if the discounting rate is 10%, if the discounting rate is 10%, if the discounting rate is 10%, determine the maximum price. Determine the maximum price that the company will be willing to pay. Determine the maximum price that the company will be willing to pay, in order to acquire the project. Determine the maximum price that the company will be willing to pay in order to acquire the project. It will be willing to pay in order to acquire the project. Then you add there a paragraph by noting that the maximum price to pay, the maximum price to pay, the maximum price to pay, the maximum price to pay is the present value. Maximum price to pay is the present value, of all the expected cash inflows. It is the present value of all the expected cash inflows. It is the present value of all the expected cash inflows to be generated by the project. It is the present value of all the expected cash flows to be generated by the project. To be generated by the project. To be generated by the project. So from this question, you can see from year 1 up to year 4, each year cash flows are the same. Year 5 to year 9, also each year the cash flows are the same. Then now from year 10 also up to infinity, cash flows will also be the same. So you want to know how to get the present value for that. So when it comes to that point, you arrange them in this manner. So we'll be having the year. Then I will give you the formula we shall be using. Then we perform some calculations at that point. So we arrange it in this manner. So I will arrange it in that order. So I will be having the year, the formula I will be applying, then I do some calculation in relation to that. Then I will do some calculations in relation to that level. So the first one will be from year 1 up to year 4. The first one is from year 1 up to year 4. So from year 1 up to year 4, cash flows are the same. We refer to it as annuity. So we discount them at the present. This is present value interest factor for the annuity. The cost of capital I've given you is 10%. Yeah, so it will be 10% of 4 years. From year 1 up to year 4, there are 4 years. So my annuity is the 30,000. My annuity is the 30,000. So I want you to check in that second table. What is 10% in year 4? I want you to check in that second table. What is 10% in year 4? What should be 10% in year 4? What should be 10% in year 4? Check 10% in year 4. You can see 10% in year 4. It should be 3 point what? Unapata 3. It's not clear. Waka hii yenye nimepeana saizi. Alternatively, unaweza confirm by calculating kumbuka it was 1 minus 1 plus r as the power of negative n divided by r. Even those who are online, kuna ile ilikuwa imetumwa kwa class group. I hope those who had seen the one for the class group. There is one which is there in the class group. So online wameniambia ni 3.1699. Yeah, so it is 3.1699. You can also check in the class group. There is one that was sent in the class group. There is one that was actually sent to the class group. So that is now from year 1 up to year 4. Then there will be another one between year 5 to year 9. There is another one between year 5 to year 9. There is another one between year 5 to year 9. So when it comes to year 5 to year 9, it will be annuity, then in brackets, present value interest factor for the annuity, 10% in year 9. So to subtract the one for which year. Going by the illustration tumefanya just the previous. I minus the one for year 4 because one between year 5 to year 9. So remember the other one was from year 3 to year 5. Ukachukua year 5 minus the one for year 2. So the same case for this one. You take the one for year 9 minus the one for year 4. So we minus present value interest factor for the annuity 10% in year 4. Like that. So the annuity there is 50,000. The annuity there is 50,000. So I want you to check again in that second table. What is there as 10% in year 9? Check 10% in year 9. Online, you confirm it is 5 point what? So 5.7590. Yeah, the one for year 4 we already have it. It is 3.1699. Like so that one we can also get the value from there. We should also be able to get the value from that point. Then we go to the next one. The next one is between year 10 up to infinity. The next one should be year 10 up to infinity. So it is also annuity, present value interest factor for the annuity, 10% up to infinity, because we have this. Then we minus the one for year 9. Yeah. Up to this one was year 9, but it is up, then we minus. So even this one, to take the one for infinity, you minus the one for year 9. So you also subtract present value interest factor for the annuity, 10% in year 9. But up to infinity, if you check in your notes, E was the present value of the annuity up to. It is not in the table, up to infinity. So up to infinity is the same as 1 over R. So up to infinity, it is not in the table. And we had discussed that in your notes. The present value of the annuity up to infinity. I suspect it is E. Yeah, so it's the same as annuity over R, or it is equal to annuity multiplied by 1 over R. So we shall be using 1 over R. So those cash flows are 20,000. Then 1 over R. This R is the cost of capital. which is 10%. So it is the same as 0.1. 10% is the same as 0.1. Then now you subtract the 1 for 9%, which is 5.7590. Like that. So now you will add those figures together to give you the present value for the cash inflows. You will add those figures together to give you the present value for the cash inflows. You will add those figures together to give you the present value of the cash inflows. So you'll be required to add them together to give you the present value of the cash inflows. So now I want us to go to your past papers. Check May 2018, question number 4D. I would like you to check May 2018, question number 4. May 2018, question 4D. May 2018. May 2018, question number 4, part D. We check May 2018, question 4D. Mine is on page 37. You can just pick it. Those who have not been given, just pick them so that we move together. Mine is on page 37. You will be able to see the question for May 2018. Am I on which page? Sorry? Others go page 1. Others, come out, you only 37, check 47, 41. So the question is about Matata Limited. The question is about Matata Limited. So you can wait for your colleagues who are going to pick the past papers, then we continue.
Now, the reason is even Then from there, it is 18 out of 1.
So you have seen now the question. So mine is on page 37. So the question reads that Matata Limited is in the process of completing the construction of a greenhouse. The construction of a greenhouse. So the finance manager has established that the project useful life is 15 years. The project useful life is meant to be 15 years and shall generate the following cash flows. And it will generate the following cash flows. So from year 1 to year 5 is given. Year 6 to year 10 is also given. 11 to 15 has also been given. So the required rate of return of the company is what percent? 10%. So the total present value of the project. The total present value of the project. So you will still arrange it this way. You will still arrange it this way because you want to get the present value. So you will arrange it, the year, the formula, and the calculation in that manner. We have done the previous question. So the first one is from year 1 up to year 5. The first one is meant to be year 1 up to year 5. Cash flows are the same from year 1 up to year 5. So you simply take the annuity multiplied by present value interest factor for the annuity. So the cost of capital is 10%. 10% for 5 years, like that. So annuity there is the 5 million. Annuity there is the 5 millions, like that. So you confirm from that annuity table. I want you to confirm from that annuity table what is 10% in year 5. What should be the 10% in year 5? 3.7. That is not clear. Others, mko na nini hapo? 3.790. So 3.7908. 3.7908. Like that. So you confirm that figure. There is another table that was sent to the class group. You can also refer to that one. Guess this one is not clear. But so we go to the next one. The next one is between year 6 to year 10. The next one is between year 6 to year 10. So it will be the annuity, present value interest factor for the annuity, 10% in year 10. We minus present value interest factor for the annuity, 10% in year 5. So the annuity is the 9 millions. Annuity is 9 millions. So confirm 10% in year 10. Confirm the 10% in year 10 from the table. It should be 6.1446. Yeah, so you already have the one for year 5, which is 3.7908. You also get the value for that. We also come up with the value for that question. Then the next one is between 11 to 15. 11, 15. So it will also be the annuity. Annuity, present value interest factor for the annuity, 10% in year 15. We minus present value interest factor for the annuity, 10% in the year 10. So this one will be 4 millions. 4 millions. Then 10% in year 15. 7.6064. 61. Then you minus the other one, you already have it. The other one, remember, you already have it. It is a figure of 6.1446. So you get the total, then you will add them together. So you get the totals, then you add them together. You have which class at 11? Oh my God. Okay.
Now, there is another question that follows there.
So you tell your colleagues, then it's tutapatana hiyo 11 instead of waiting at 2. So we are supposed to have a class with you part 2. Yeah, so tutaisoma at 11 kama mwalimu efara haiko. Online, I hope you get that information. So the class for at 2, we shall do it at 11 because mwalimu for FR is not there. Is the information communicated? Those who are online. Yeah, so we shall also have the same class from 11. So what is the total? $45,984,200. So that is for that question. Let us also check September 2015. September 2015, question number 4, part A. September 2015, question number 4, part A. Also check September 2015, question number 4, part A. September 2015, question number 4, part A. And also check September 2015, question number 4, part A. September 2015, question number 4, part A. So that sitting, it was a pilot paper, it was not an exam. Should be question number 4, part A. Mine is on page, mine is page 60. Mine is on page 60. Are you able to see question about A Limited is considering taking over B Limited? Mnaiona hiyo swali? Yeah, so we go through that question. Mine is on page 60. So others, I don't know it is on which page. So online, we have seen the question. So the question reads that A Limited is considering taking over B Limited. A Limited is considering taking over B Limited. The forecasted annual net operating cash flows to be generated by the target firm are given as follows. So they gave you year 1, it is 5 million. Year 2, it is 8 million. So those are not annuities. So those ones you use the first table because they are not annuities. But year 3 to year 7, it is an annuity, you use the second table. Year 8 to year 10, it is annuity, we use the second table. Year 8 up to infinity, sorry, year 8 up to year 10, it is annuity, we use the second table. Then 11 and above, it is the same as 11 up to infinity. Above is not specified, it means it is up to infinity. We also use the second table. The firm's minimum required rate of return is 5% above the risk-free rate of return. The risk-free rate of return is 15%. So that means your cost of capital, you take 15% plus 5, because that's what they have specified. They have said that minimum required rate of return is 5% above what? The risk-free rate. But the risk-free rate is provided as 15. So our cost of capital will be 15 plus 5, which will be 20. So required maximum price payable by A Limited to acquire B Limited. So we shall follow the same. So the cost of capital, will simply be equal to 15% plus 5%, which will be 20%. Then after that, we now follow this approach. We follow this same format. We shall also be able now to follow this particular format. So we start off with year one. So the one for year one, it is meant to be 5 millions. 5 millions multiplied by the present value interest factor, 20% in year one. So this one, we are using the first table, but first, the year one is the same for both tables. Year one is normally the same. So it will be 5 millions, confirm 20% in year one. We confirm 20% in year one. 0.3 multiplied 2. Yeah, so you multiply by the 5 million to get the present value for that. Get the present value for that portion. Then year two. Year two, it will also be given by 8 millions. Also present value interest factor, 20% in year two. 20% in year two. So when it comes there, it will be now 8 million. So you also confirm 20% in year two in the first table. 0.6944. The next one is between year 3 to year 7. Year 3 to, so this time around, year 3 to year 7, it will be annuity. Year 3 to year 7, so we take the annuity, then present value interest factor for the annuity, 20% in year 7. Remember, we subtract the one for each year. We minus the one for year 2. So present value interest factor for the annuity, 20% in year 2. So that annuity is what you have been given as 10 millions. We have it as 10 millions. So confirm 20% in year 7. You confirm 20% in year 7. We are now using the second table. It is 3.6 what? 046. Also, you still use the second table, 20% in year 2. Still in the second table, 20% in year 2. It was 1.1 point what? 1.5. The next one is year 8 to year 10. The next one is meant to be year 8 to year 10. So also annuity, present value interest factor for the annuity, 20% in year 10. Also subtract present value interest factor for the annuity, 20% in year 7.
You can see they are producing 256,000 units. But for the purposes of
so 15 million. So 20% in year 10. 4.1925. So the one for year 7, you already have it, 3.6046. You also get the value for it.
So we have identified all the items that are due. At that point, I told you to now substitute. But before you substitute, you need to know whether there is a case of.
Then finally, the last one is between year 11 up to infinity. Year 11 up to infinity. So it will be annuity. Then present value interest factor for the annuity, 20% up to infinity. E minus present value interest factor for the annuity, 20% in year 10. 20% in. So up to infinity, I said it is given by 1 over r. Up to infinity, it will be 1 over r. So just take 1 divided by 0.2, because 20% will be the same as 0.2. Then you subtract 4.1925. So now you will add those figures together to give you the maximum price to pay.
So then that is required to get this 4. Y was 4. We divide 4 minus y for 5. Y
So we are getting a total of which figure? 48,998. Yeah, so let us now have a brief subtopic as loan repayment schedule. We can now have a subtopic as loan repayment schedule. So those who are online, we start a new subtopic. A new subtopic as loan repayment schedule. We can now have a new subtopic as loan repayment schedule. The loan repayment schedule. Loan repayment schedule. So let us write something brief on the loan repayment schedule. So we can summarize that it shows the amount borrowed. It shows the amount borrowed, comma, installment payment, comma, balance outstanding for each period, the balance outstanding for each period, the balance outstanding for each period, comma, the principal amount, and the interest, the principal amount and the interest for each period, the principal amount and the interest for each period. Then another paragraph, we note that the installment amount paid at the end of each period, the installment amount paid at the end of each period, the installment amount paid at the end of each period will represent the annuity, and it is computed as follows. It will represent the annuity and it is computed as follows. And it is computed as follows. So to calculate the installment payment, so installment payment will be equal to amount borrowed. Divided by present value interest factor for the annuity at R%. So when you want to compute installment payment, you simply take amount borrowed, we divide by present value interest factor for the annuity at R% in period N. So that part we should be using the annuity table. So that denominator is simply the annuity table. So we are saying that the installment amount paid at the end of the period will shows the amount of the annuity, and it is computed as follows. So the formula for the installment payment will be equal to amount borrowed. You divide by the present value interest factor for the annuity at R% in period N. So is it clear? Someone was asking to be pardoned. Are you okay at that level? So which first line? About the loan repayment schedule. Is it the meaning? So the meaning, I had said that it shows the amount borrowed. It shows the amount borrowed, installment payment for each period, outstanding balance at the end of each period, the principal amount and the interest for each period, and the interest for each period. So I hope it is clear. So another paragraph, we can now write that. Another paragraph, we note that the installment payment has two components. The installment payment has two components. The installment payment has two components, i.e., the principal amount and interest, i.e., the principal amount and interest. The principal amount and interest. The principal amount and the interest. So I want us now to get a question from your past papers. You want now to get a question. December 2021. December 2021. December 2021. December 2021. Question number 3, part B. That is for the exam. Remember, December 2021 are 2. There is the one for the pilot paper and the exam. We only want the one for the exam. So check December 2021, question number 3, part B. December 2021, question 3, part B. So the one for Sofin Limited, borrowed shillings 15 million. Some people are still looking for it. Mine is on page 5. When you go to page 5, or others, it's on which page? Page 9. Yeah, so either you check page 9 or page 5. So they are able to see for Limited, borrowed shillings 15 million from Baraka Bank at an annual interest rate of what percent? 16%. 16%, repayable in 4 equal annual installments at the end of each year. So prepare a loan amortization schedule for the company. So repayment is the same as amortization. When they say amortization is the same as the loan repayment schedule for the company. So let us see how we can now prepare the loan amortization or repayment schedule for that company. So the starting point is for you to calculate the installment payment. For you is to compute the installment payment. So to get the installment payment, for us to calculate the installment payment, it is supposed to be given by amount borrowed. amount borrowed, we divide by present value interest factor for the annuity. Remember, interest rate is given as what percent? 16% for how many years? So they pay it within 4 years. So amount borrowed from the question was how much? It is 15 millions. So you go to the second table, confirm 16% in year 4. In the second table, you confirm 16% in year 4. So what will be 16% in year 4? 2.7982. So divide to give you the installment payment. So compute to get the installment payment. We calculate to get the installment payment. We compute to get the installment payment. So you round the amount off. So when you round it off, it will be how much? 5,316,000. When you round off to be 560. 589 letters. Yeah, so that should be your installment. So now after the installment, we now come up with the loan amortization schedule. So we now prepare the loan amortization schedule. The loan amortization schedule. We now prepare the loan amortization schedule. So in the loan amortization schedule, we start off with the year. We shall be having the year. Then amount at the start. Amount at the start. Amount at the start. Then we shall also be having the installment. Shall be having the installment. Then apart from the installment, also interest at 16% per annum. Then after that, the principal amount like that. So the year amount at the start, installment, interest at 60% per annum, then the principal amount. Then the principal amount. So we simplify it in that order. We simplify the information in that order. So we start off with year 1. We start off with year 1. Amount at the start of year 1 is 15 millions. It's meant to be 15 millions. Installment, it is 5,316,589. So interest, I want you to get 60% of the amount at the start. So what should be 16% of the 15 bills? Sorry? 24 is exactly 2.4. So it is 2.4 millions. And then subtract interest from the installment to get the principal amount. So to get the principal amount, you less interest from the installment. We minus interest from the installment. We minus interest from the installment. Itakuja which figure? 8 and 9. So when you subtract this principal amount from this amount at the start, it will give you the balance at the end of the year, which is the same as the balance at the start of year 2. So to get this balance at the start of year 2, subtract the principal from this figure at the start to get the amount at the start of year 2. So to get the balance at the start of year 2, you minus the principal from the amount at the start of year 1. So what should be now the balance at the start of year 2? Amount at the start of year 2. 12,039. 411 like that. Yeah, so installment amount will remain the same. Installment amount will remain the same. So interest gets 16% of 12,039 for 11. This 1,926,306. Then also subtract interest from the installment to get the principal amount. You also subtract interest from the installment to get the principal amount. So what should we get as the principal amount? 3,434,283. So you also subtract this principal from the amount of the start of year 2, so that we get the balance at the start of year 3. We get the balance at the start of year 3. So what should be the balance at the start of year 3? 8,605,128. So we say installment will not change. It still remain 5,360,589. So what should be the interest? 16% of 8,605,128. 1,876,000. Sorry, 376,820. Then when you subtract this from this, what should be here? 3,000,000 983 769. So also subtract that from the amount at the start to give you the figure at the start of year 4. It is 4,621,359. So hii ingine tulisema inabaki the same 5,360,589. So get the interest and also get the principal amount.
Is 80%. Are we okay? Other things are I'm asking whether we are okay. Now, we all abstract November 2019, November 2019, 5/8, 5/8. Remember, I told you the exercise 4.2. So we are now yeah. Now the next is called target cost. Called target cost. Right. All the other methods. Determine their own price. And then the other one is find the price. That's what happens the provider of service or the user of the product sets their own price. Other than that, but the customer asks how much are you able to pay for this product or this part. Now, what was you get to ask how much if you are the customer is expected to one.
Hiyo ya mwisho inakuja ngapi? So, hii mlipata wapi? So it should be the same as here. Because of the rounding off, that's why you're getting that variation. But the last one, just make this figure to be the same as that, so that there is no balance remaining. So there's like a small variation there, isn't it? But it is because of the rounding off. It is because, see, figure had been rounded off here. It is rounded off to 4 decimal places. After you part up, will round off. So make sure that the last period, E value in the same as the one at the start, so that there is no balance carried forward, because the loan must be cleared by the end of the year. So from there, we should now also go to another question. So this one, I want you to check. So I also want you to check in the sitting of December 2014. December 2014. There is a question number 3, part A. December 2014, question 3, part A. December 2014, question number 3, part A. December 2014, question number 3, part A. So that question 3, part A, Roman letter 1, mine is on page 67. Mine is on page 67. Others, which page? So that question 3, part A, Roman letter 1. Question 3, part A, Roman letter 1. The one they have said that John Matata has just borrowed shillings 220,000 from the bank at 12% per annum, computed annually, to be repaid in 6 equal annual installments. So these payments are to be sufficient to repay the principal amount together with the interest. So required, it is a loan amortization schedule. So you start off with installment payment. So this one, interest rate is what percent? 12%. So this one will be 12% for how many periods? It's 6 years. Yeah, so it is 6 periods, which is the same as the 6 years. So when it comes to this part, the amount is 220. So you confirm in the annuity table what is 12% in period 6. You check in the annuity table what should be 12% in period 6. So that we get the installment payment. So now you start again the same way. We now prepare the loan amortization schedule. So this one should be 12%. So we start off with 1. So the amount there is 220. Installment is 53,510. So interest will be 12% of 220. $26,400. So when you subtract from 53,510, the principal amount should be which figure? Sorry? 27,110. So you subtract it from the 220 to start the amount at the start of period 2. 1 82, 192, 890. So your installment is back to the same. Okay. So you proceed like that up to the end. We shall proceed in that order up to the end. So it is time. We can have a short break. We meet at exactly 11 so that we can see whether we can finish that portion.
When you should again with graduate. Yeah, actually, that's how cheap. But you do it. Chinese are cheap. Lakini hata mwisho si kwa alafu na alafu na nini iko tena kuna kitu fulani food ya just want to know the rice natural it's a food mesikia tipa wana so ni githeri ndogo kule chapati lakini pilau sana hizo asa pilau hivi atu wale unashiba aje kwani wewe ni katuni mtu wazoea za kusikia tena tunaweza kusikia dawa watatu ama dawa si kama ni hapa wakati nimeanza lakini ukasiwa I'm passing here for people. Utume group. Mimi watu ati mimi leta nawezi watu formation ya kama hiyo wewe na bwana sia kufanya hicho ndio fikiri ndio basi kwa ni shares sasa wewe uko nani uko nani hauna membership shares ndio hicho Thank you.
So, good morning. Tulimaliza hiyo swali yetu. So have we finished? We check another question. So we can also add there another illustration. So this one is not in your past papers. I want you to write it down in your book. So you can also write down this illustration in your book. So you can note that K Limited borrowed shillings 1 million. Borrowed shillings 1 million from a local bank. Borrowed shillings 1 million from a local bank. Repayable semi-annually. Repayable semi-annually. Repayable semi-annually over a 3-year period. Repayable semi-annually over a 3-year period. Repayable semi-annually over a 3-year period. The interest rate on the loan is 12% per annum. The interest rate on the loan is 12% per annum. The interest rate on the loan is 12% per annum. So required is that prepare the loan repayment schedule. Prepare the loan repayment schedule over the 3-year period. Prepare the loan repayment schedule over the 3-year period. Prepare the loan repayment schedule over the 3-year period. So let us see how now to do. So this time around, the loan is repaid semi-annually, twice in a year. So we need to come up with N. We need to come up with N. So N, it will now be 3 years multiplied by 2. Because the loan is repaid over the 3-year period, but they pay it semi-annually. So you take 3 multiplied by 2. You take 3 multiplied by 2, will be able to give us 6. Then R, I've given you per annum. I've given you what percent per annum? So 12% divided by 2 to be repaid semi-annually, because they pay after every 6 months. So 12 is for 1 year. How about 6 months? So you take the 12% divided by 2, which means every 6 months we pay what percent? So it will be 6%. So from there, we can now calculate the installment amount. So installment amount will be given by amount borrowed. Then we divide by present value, interest factor for the annuity, 6% in period 6. 6% in period 6. So I've said the amount borrowed was how much? It is 1 million. So you can confirm now in the annuity table. What is there as 6% in period 6? We use now the second table, the annuity table. We use the annuity table. So 6% in period 6 should be the same as which value? 4.1. 4.19. 91. 4.9173. Yeah, so now get that installment payment. So to come up with what is supposed to be the installment payment. What should be now the installment payment? What should be the value for the installment payment? Inakuja 200 and what? So I've seen 203. So after that, now we prepare the loan repayment schedule. Now we go to the loan repayment schedule. So in the loan repayment schedule, we start afresh the way we had done the other one. So this time we use the period, then amount at the start. Amount at the start. Then installment. Then we shall be having the installment amount. Installment amount. Then interest at 6%, interest at 6%. Then also the principal amount. The principal amount like that. So there will be the period amount at the start, installment, interest at 6%, also principal amount. So we start off with period 1. Amount at the start of period 1 will be 1 million. Installment is 203,364. 203,364. So interest 6% of 1 million. Is it 60,000? Yeah, so 60,000. We subtract the 60,000 from 203,364 to get the installment. It will be 100 and what? 143. 364. So subtract that figure from 1 million now to get the amount at the start of period 2. 856. 636. So installment we had agreed it will not change. Installment we say it will just remain the same. So interest, get 6% of 853, 636. 50. So we get 51, 398. So that the principal amount should be which figure? 151 and 67. Yeah, so now we proceed in that order up to the last one. So you can now proceed in that order up. So there are 6 periods. So you go to period 3, period 4, period 5, and also period 6. So that we now also conclude the amount. So we are finished. Interest in the last period is how much? Interest in period 6. 11,511. Yeah, so online, I hope you have finished the question. Online, are we through the question? So one more last question. One more last question is December 2013, question number 2 part C. December 2013, question 2C. So, December 2013, question number 2, part C. December 2013, question number 2, part C. December 2013, question 2, part C. So that's December 2013, question number 2, part C. So the question reads that Shadrach Chandra borrowed shillings 80,000. So borrowed shillings 80,000. So from XYZ Commercial Bank at an interest rate of 1.25% compounded monthly. The loan is to be amortized using the reducing balance method and repaid in 12% monthly installment, payable at the end of each month. Payable at the end of each month. So required a loan amortization schedule. A loan amortization schedule. So they have given you 1.25%, but that figure is not in the table. So that's why I want us to look at the question. If you get a figure that is not in the table, how do you go about the same? So we start by calculating that figure because it is not in the table. For us to get the installments, so for us to get the installment, so installment is supposed to be given by the installment payment or simply amount. Installment amount equal to amount borrowed. Amount borrowed. We divide by present value interest factor for the annuity. So they gave us 1.25%. 1.25% for 12 periods, the 12 months. They said it is payable monthly. That means 12 months. So 1.25% is not in the table. So to compute that figure, for us to get that value of the present value interest factor, 1.25% in period 12. So I used the formula whereby it was 1 then minus 1 plus r raised to the power of -n. We divide by r. Remember the figures in the second table are given by this formula. This formula we discussed it under the annuity. Annuity, when you want to get the values in the second table, we normally apply this question. So what we do at that level is that it will simply be 1 minus 1 plus r. So r is the 1.25. 1.25 divided by 100 will be the same as 0.1. 1.25. So raise to the power of -12. Then divide by 0.0125. So that figure, I would like you to round it off to 4 decimal places. You should round it off into 4 decimal places before we can apply it. You round it off into 4 decimal places before we can be in a position So you get which figure when you calculate the figure that you have just calculated. 11 point what? So 11.0. So now once you have done that, we can now get the installment. The installment amount. So installment amount, the amount that was borrowed was 80,000. The amount that was borrowed was 80,000. So now you take the 80,000, divide by 11.0793. So that you get now the installment amount. So that we come up with the installment amount. Come up with the installment amount. So it will appear which figure? 72.21. So we get 72. So now we can prepare our loan repayment schedule. So from there, we come up with our loan repayment schedule. Now come up with the loan repayment schedule. So in your loan repayment schedule, our loan repayment schedule, we should be having, remember the period, amount at the start, amount at the start, then installment amount, then after that interest at 1.25%. Then you have the principal amount. The principal. So we should be having the period, amount at the start, installment amount, interest at 1.25%, also the principal amount. So we start off with period 1. So amount at the start of period 1 is 80,000. So installment is 72.21. So interest, what is 1.25% of 80,000? So it is 1,000. So you subtract the 1,000 from the installment to get the principal. Will be 62.21. Then now you subtract the principal from the 80,000 to get the figure at the start of period 2. So at the start of period 2, you should have how much? 779. Yeah, so now we proceed in that order up to period 12. Remember, it was for 12 months. So now you follow that order up to period 12. You now proceed that order up to period 12. Now follow that order up to 12. Pronouncement of professional rules announcement of standards and standards professional and regular professional and during the entry of the profession. On all reports, Finished. Yeah, so now we can start something new, a topic as rights issue. We can now start another topic as rights. Let's start another topic as the rights issue. The rights issue. Now start another topic as rights issue. The rights issue. So when it comes to the right issue, it will simply be a method of raising new equity capital to finance a new project. So what normally happens, you give additional ordinary shares to the existing shareholders in order to raise the new capital. So it is a way of raising new finances to finance a new project by issuing additional shares to the existing shareholders, but at a price slightly below the market price, and also in the proportion to their current shareholding. So it is not a major topic, but it is so much examinable. That's why I pick that portion, because it is part of the sources of finance. And sources of finance, there are so many of them. But now this is what they normally test in terms of the computation. That's why I want us to start from that area. So we can introduce something brief about the right issue. We can summarize that this is a method of raising equity capital. This is a method of raising equity capital to finance a new project. A method of raising equity capital to finance a new project. To finance a new project. Another paragraph. Under this method, the company will issue additional ordinary shares. The company will issue additional ordinary shares to the existing shareholders, in the proportion to their current shareholding, at a price slightly below current market price per share, at a price slightly below the current market price per share, at a price slightly below the current market price per share. Therefore, shares are issued at a discount. Therefore, shares are issued at a discount. Another paragraph is that the price at which shares are issued, is known as the subscription price. The price at which shares are issued is known as the subscription price, or the offer price, or issuing price, So that's now the meaning of the right issue. Then we can now also have a subtopic as come rights, market price per share, Can also have a subtopic as come rights, market price per share. We can also write something brief as come right market price per share. So this will simply be the price of the share after they have announced that there will be a right issue, but before it takes place. So that price which is selling on the shares, when you announce that right issue will take place, but before it takes place, during that time, the price is known as the come right market price per share. Because we want to give shares to the existing shareholders, we need to make an announcement first. So that time of making the announcement and the time the shares will be issued, during that period, the price of that share will be known as come right market price per share. So we note that, we summarize that it is the price of the share. It is the price of the share after announcement of the right issue. Is the price of the share after announcement of the right issue. After the announcement of the right issue, but before the right issue takes place. 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 Then we continue by noting that it is computed as follows. 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 So now to calculate, write market price per share. So write market price per share. Write market price per share would be equal to market price per share. Market price per share. Market price per share. Market price per share before announcement. Before the announcement of the rights issue. Before the announcement of the right issue. Then we add net present value. Net present value per share. So to calculate write market price per share, we simply take market price per share before announcement of the right issue. Then we add net present value per share. So this is the same as NPV. Net present value per share. So we have it in brackets as NPV. Then to calculate the net present value. So net present value. Net present value will be given by present value of the cash inflows. Present value of cash inflows, we minus present value of cash outflows. So to calculate the net present value, it is simply present value of cash inflows. We minus present value of cash outflows. So in summary, it will be NPV should be equal to the present value like that of the cash inflows minus present value for the cash outflows. So we simplify it in that order. So to get the NPV, it is simply that format of the present value for the cash inflows, we minus the present value for the cash outflows. So we go back to December 2013. Go back to the sitting of December 2013. Question number 1, part B. December 2013, question 1, part B. We go back to the same sitting of December 2013, question number 1, part B. So that question 1, part B for December 2013. The question reads that Bridge Limited intend to raise shillings 50 million to finance a new project through a right issue. The project has a 10-year economic life with 0 scrap value. So the project is expected to generate annual cash inflows of shillings 14 millions. Annual cash inflows of shillings 14 million. The company has 10 million issued under fully paid up ordinary shares. The company has 10 million issued under fully paid up ordinary shares. The market price of the company's ordinary shares before the announcement of the right issue was 35 shillings per share. The company's cost of capital is 14%. So required right price of the share. They would like you to compute the right price of the share. So to calculate the right market price of the share, it is simply market price per share before announcement of the right issue, which has been given. Then you add the NPV. So let us now see how we shall be calculating the net present value so that we can now answer the question. So we want now first to see how to calculate the net present value. We want now to know how we can be able to compute the net present value. So to calculate the net present value, we have simply stated that NPV should be given by present value for the cash inflows, P minus present value for the cash outflows. So we start with present value for the cash inflows. So present value for the cash inflows, it will be given by annuity multiplied by present value interest factor for the annuity. Remember, the question has given you the cost of capital. Are you able to see the company's cost of capital at the end of the question? They have given us 14%. Then the economic life of the project, it has 10 years. So it has 10 years. So annuity is the same cash flows every year for the 10 years. Annuity is the same cash flows every year for the 10 years. So the question says that the project is expected to generate annual cash inflows of how much? 14 million. So we take 14 millions. You check in the second table, sorry, annuity table. Annuity table, confirm 14% in period 10. In the annuity table, you check 14% in period 10. 14% in period 10. The second table. Now, which figure? 5.2161. So multiply to give you present value for the cash inflows. You multiply to give you the present value for the cash inflows. We multiply to get the present value for the cash inflows. So once you get present value for the cash inflows, now you also less present value for the cash outflow. So present value of the cash outflow will be the cost of the project. Present value for the cash outflow is meant to be the cost of the project. So the cost of the project is the amount they want to raise to finance the project. So they intend to raise how much to finance the new project? Yeah, so present value for the cash outflow is always the amount required to finance the new project. So that figure is 50 millions. So you subtract from what was there as the present value for the cash inflows to get the NPV. So what should be our net present value? 23 point what? 0 205 like that.
025.
Yeah. It's 23 million 02 54 like that. But we just want it per share. We want the NPV per share. We shall finally round it off. So NPV per share. NPV per share. You now take that NPV of 23.0254 million. Divide by the number of the ordinary shares. You want to get the NPV per share. So how many shares were issued? The company has 10 million issued and fully paid up ordinary shares. So we divide by 10 million ordinary shares. So finally, it will simply be 2.30. It will be 2.30. When we round it off to 3 decimal places, 2.30, 3 like that. Yeah, we can just require it at that point. So that we get per share. So that we get it as per share. So now after that, we can calculate the right market price. So right market price, we have said it is market price per share before announcement of the right issue. So what price are you given in the question before the announcement of the right issue? So now you take the 35, then you add 2.303. So that is now our right market price per share. That now will be our right market price per share. Now give you the right market price per share. It should be able to give you the right market price per share. So after that, I will also like to write something brief about theoretical right price. After the right market price, we shall also write something brief about we can also write something brief about theoretical should be theoretical right price. Theoretical, there is an or there. Theoretical right price, market price. So you can also write something brief about theoretical right market price. A theoretical right market price. The theoretical right market price. So when it comes now to the theoretical market price, it is the price of the share after the right issue has taken place. So that's now what we'll be referring to as the theoretical right market price. So we note that it is the market price per share. It is the market price per share after the right issue has taken place. It is the market price per share after the rights issue has taken place. After the right issue have taken place. After the right issue have taken place. Then we continue by noting that after the right issue, comma, there is increased supply of the company shares. After the right issue, comma, there is increased supply of the company shares. There is increased supply of the company shares in the stock exchange. In the stock exchange. Therefore, the price per share Therefore, the price per share will decline. Therefore, the price per share will decline. Therefore, the price per share will decline. Then we continue by noting that the theoretical X-right price, will be expressed as follows. The theoretical X-right price will be expressed as follows. The theoretical X-right price will be expressed as follows. So this is now how we shall be able to compute the theoretical. So this one will be referring to theoretical X-right price. This sign we call the theoretical X-right price. It will be equal to current market value of equity. Current market value of equity. Then we shall be required to add. New funds to be raised. New funds to be raised through the rights issue. Rights issue. Then we divide by existing number of the ordinary shares. Existing number of the ordinary shares. Existing number of the ordinary shares. Then we add number of the new shares to be issued. Number of shares. So when you want to compute the theoretical X-right price, it will simply be given by current market value of equity. You add new funds to be raised through the right issue, divide by existing number of the ordinary shares, then you add number of the new shares to be issued. We add the number of the new shares to be issued. Then to calculate where current market value of equity, current market value of equity, it will be equal to existing number of the ordinary shares. Existing number of ordinary shares multiplied by current market price per share, multiplied by the current market price per share. So when you want to calculate current market value of equity, simply take existing number of the ordinary shares multiplied by the current market price per share. Then also new funds to be raised. New funds to be raised will be equal to number of the new shares to be issued. Number of the new shares to be issued. Number of the new shares to be issued multiplied by the offer price. Offer price. Remember, we said offer price is also known as the subscription price or the issue price. When you want to calculate new funds to be raised, it is simply number of the new shares to be issued. We multiply by their offer price. We multiply it by their offer price. So from there, I would also like to write something brief. We can have as a topic as number of the rights. We can also write something brief about number of rights. We can also write something brief about the number of the rights. The number of the rights. We can also write something brief about number of the rights. So when it comes to the number of the rights, we note that it indicates the number of the shares to be issued. It indicates the number of the shares to be issued in order to acquire one new ordinary share. It indicates the number of the new share, the number of the shares to be issued in order to acquire one new ordinary share. It indicates the number of the shares to be issued in order to acquire one new ordinary share. Then we continue by noting that it is calculated as follows. 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 So, for us to get the number of the rights, number of the rights are simply indicating the number of the shares that must be issued in order to acquire one new share. So, we say that number of the rights, will be given by existing number of ordinary shares. Number of ordinary shares. We divide by the number of the new shares. Number of the new shares. Number of the new shares to be issued. Number of the new shares to be issued. So when you want to calculate number of the rights, it will simply be equal to existing number of the ordinary shares. We divide by number of the new shares to be issued. We divide by the number of the new shares to be issued. So there's a correction you make up there in the explanation. It should have read that it indicates the number of the shares required but not issued. You see where it indicates the number of the shares required in order to acquire one new ordinary share. It indicates the number of the shares required in order to acquire one new ordinary share. You see the first paragraph? Yeah, it indicates the number of the shares required, not issued. It indicates the number of the shares required in order to acquire one new share. So the number of the shares you must have for you to get one new share is what we refer to as the number of the rights. So it will tell us you require how many shares for you to get one new additional share. That's now the ratio of how it will be able to work. Then another paragraph, we note that the number of the rights normally have the value. Number of the rights normally have the value. Number of the rights normally have the value. Number of the rights, they normally have the value. And the value of the right will be expressed as follows. And the value of the right will be expressed as follows. And the value of the right will be expressed as follows. Value of the right will be expressed as follows. So there are three formulas. Each one of them will give you the same. So you will only be using one depending on the information given in the question. So the first one, value of the right, will be given by market price per share minus the theoretical ex-right price. So the first formula, value of the right will be equal to market price per share minus the theoretical ex-right price. Market price per share, you subtract the theoretical ex-right price. Or alternatively, also to get the same value for the right, it will be given by market price per share. We subtract the offer price. We divide by number of the rights. Then you add 1 like that. Another formula will be that value of the right will also be equal to market price per share minus the offer price, divide by the number of the rights, then you add 1. The last one, another formula of also how to get the same. Number 3 will be that value of the right will also be given by theoretical ex-right price minus the offer price, divide by number of the rights, divide by number of the rights, like that. Also to get value of the right will be equal to theoretical ex-right price minus the offer price, but now you only divide by the number of the rights. Then now we can add there another paragraph by noting that during the right issue, a new paragraph, during the right issue, comma, the existing shareholder have 3 options. The existing shareholder have 3 options. The existing shareholder have 3 options. Number 1 will be that exercise of the rights. Number 1 will be exercise of the rights. Exercise of the rights. So under that exercise of the rights, you know that it is where during the right issue, comma, the existing shareholder will buy the right issue shares. The existing shareholder will buy the right issue shares. Will buy the right issue shares and keep them. Will buy the right issue shares and keep them. The number 2 will be sale of the rights. Number 2 will be sale of the rights. Number 2 will be sale of the rights. So under the sale of the rights, you know that under this option is that during the right issue, the shareholder will acquire the right issue shares. The shareholder will acquire the right issue shares. The shareholder will acquire the right issue shares and to sell them in the open market. Will acquire the right issue shares and sell them in the open market. I.e. the stock exchange market. Then number 3 will be ignore the rights issue. Number 3 will be ignore the rights issue. So under that, you note that in this case, the shareholder will not participate in the right issue. In this case, the shareholder will not participate in the right issue when it is taking place. The shareholder will not participate in the right issue when it is taking place. The shareholder will not participate in the right issue when it is taking place. So some people may not be having money, and therefore during the exercise, they may not participate. That's now when you ignore the right issue. Then another paragraph, you also summarize that when evaluating the three options, comma, the investor should consider, when evaluating the three options, comma, the investor should consider, Roman letter one will be his percentage of ownership, his percentage of ownership before and after the rights issue, his percentage of ownership before and after the rights issue, his percentage of ownership before and after the rights issue. Roman letter two is meant to be his wallet status, before and after the rights issue, his wallet status before and after the rights issue, his wallet status before and after the rights issue, his wallet status before and after the rights issue. So there are some questions now in your past papers which I want us to go through. There are some questions in your past papers which we can be able to go through. So the first question should be December 2021. December 2021. It's a question number 2, part B. There are two December 2021, the pilot paper and the one for the exam. So we use the one for the exam. December 2021, question 2, part B. Mine is on page 4. There were two Decembers 2021, the one for the exam and the one for the pilot paper. So I want us to check the one for the exam, December 2021, question 2, part B. So that question 2, part B says that the question number 2, part B, the one for QRS Limited is planning to expand its production capacity. Is planning to expand its production capacity as per its marketing strategy. As a result of access to the new market. The company requires additional capital. Of 95 millions, which it intends to raise through a right issue. Sorry, just a minute. We can now proceed with the question where they had got to say that which, so the company requires additional capital of 95 millions, which it intends to raise through a right issue. So the company's financial year ends on 30th June. So additional information, note number one, the company pre-tax profit. So pre-tax is the same as before the tax. Pre-tax is the same as before the tax. For the year ended 30th June 2021 was 177.5 millions. This represents a 30% increase over the period of the previous year. So the current market price per share is given as 12. So the right issue will comprise 1 share for every how many shares held. Yeah, so those are the number of the rights. When you have 4 shares, you get 1 new share. So this question has already given us the number of the rights. The number of the rights are 4. Remember the number of the rights, we say that they indicate the number of the shares required for you to acquire 1 new share. So the number of the rights are already given to you. Then they continued also to say that the issue price is how much? 8. Then the dividend per share for the year ended 30th June 2021 was 0.7. The company expects to pay a dividend per share of 0.90 for the year ending 30th June 2022. The corporate tax rate is 30%. So now required existing number of the ordinary shares before the right issue. Number 2, earning per share and the price earning ratio for the year ended 30th June 2021. For the year ended 30th June 2021. Then they continued also to the ex-right price per share. So let us start with the Roman letter 1, existing number of the shares before the right issue. Existing number of the shares before the right issue. So to compute the existing number of the shares before the right issue, it is possible to calculate because the question had given you the number of the rights. It has also given you the amount to raise. You see the amount required to raise? Then they have also given the offer price. So what we need to do first is to get the new shares to be issued because it is possible. So we had said that new funds will be raised. We say that new funds to be raised. It was supposed to be given by the new shares to be issued. New shares to be issued. We multiplied by the offer price. We multiplied by the offer price. Multiplied by the offer price. So we make the new shares to be issued to be the subject. New shares be issued to be the subject. So it will be given by new funds to be raised. New funds to be raised. Divide by the offer price. So new funds to be raised is the amount required to finance the new project. The company requires additional capital of how much? 95 million. You see that? That's now the new funds to be raised. You take 95 millions. Take 95 millions. We divide by their offer. So offer price in the note number 3. They gave you which price? 8. So divide by 8 so that we get the new shares to be issued. So that we get the new shares to be issued. New shares to be issued. Yeah. Like 11.875. Then also after that, we need to get now the shares to be issued. So the existing ordinary share, but that one, we use the formula for the number of the rights. I gave you the formula, number of the rights. Number of the rights will be equal to existing ordinary shares. We divide by new shares to be issued. So existing ordinary shares. Existing ordinary shares will be equal to the number of the rights multiplied by the new shares. Number of the rights multiplied by new shares to be issued. So number of the rights were given. 4 shares. The number of the rights are 4 to get 1 new share. They now multiplied by 11.875. So that's now how to come up with the existing number of the ordinary shares. So to get the existing number of the ordinary shares, you simply take the number of the rights multiplied by the new shares to be issued. So that is now your Roman letter 1. That is now meant to be your Roman letter 1.
But nobody is elected. Because if somebody is setting the fee at 10,000
So we now go to the Roman letter 2, earning per share and the price earning ratio for the year ended 30th June 2021. So they want you to calculate the earning per share. So remember, this one is before the right issue. 2021 is before the right issue because they are planning to raise new capital to finance the new project. So normally to get the earning per share will be given by, so earnings per share. So the earnings per share. Earnings per share is supposed to be given by earnings available. So earnings per share is supposed to be given by the earnings available. Earnings available divided by the number of the ordinary shares. Number of the ordinary shares. So earnings available is the same as the earnings after the tax. Earnings available will be the same as the earnings after the tax. So to calculate your earnings after the tax, the question had given you the corporate tax. The corporate tax was given as what percent in the note number 5. So that means we minus the tax, we should be left with 70%. So get 70% of the pre-tax profit. The pre-tax profit was how much in the note number 1? 177.5. 177.5 millions, like that. 177.5 millions. 24 points. Yeah, so now after that, we can now get our earnings per share. 124.25 millions. Divide by the existing number of the ordinary shares you calculated. There were how many ordinary shares? 47.5. Yeah, so that was now meant to give you the earning per share. That is what was meant to give you the earnings per share. So it's a good 2.6. 2.616. So you can just have it as 2.62 per share. Then after that, we go to this price earning ratio. They wanted the earning per share and also the price earning ratio. So price earning ratio is supposed to be given by market price per share divided by the earnings per share. So price earning ratio will be market price per share divided by the earnings per share. So market price per share was given to you. Are you able to see the note number 2? Current market price per share is what? So you take 12 divided by 2.6. Then now, after that, we go to the Roman letter. We shall be required to go to the Roman letter 3. Roman letter 3 is the theoretical ex-right price per share. We want to also compute the theoretical ex-right price of the share. So I will show you 2 formats on how to get the same. How to calculate the theoretical ex-right price of the share. So theoretical ex-right price of the share. The theoretical ex, so it is given by current market value of equity. The current market value of and new funds to be raised. We divide by the existing number of the ordinary shares. Existing number of the ordinary shares. And new shares to be issued. New shares to be so when you want to get the theoretical X, so existing number of the shares we have just calculated. There are how many existing? The existing number of the ordinary shares we calculated from letter 1. Sorry. So you take 47.5 millions multiplied by the current market price per share to get current market value for equity. Current market price per share was 12. Then new funds to be raised. Remember the new funds to be raised? Yeah, we were supposed to raise how much to finance the new project? In the first paragraph, 95 million. That one was the new funds to be raised. Or alternatively, take the new shares to be issued, not by the offer price, isn't it? But it will still give you the same information. Then we divide by existing number of the ordinary shares are 47.5. So how many new shares are to be issued? We calculated. Number of the shares to be issued, we got how many? 11.875. So that will give you the theoretical exit price. It will be able to give you the theoretical exit price. Give us the theoretical exit price. 11.2. Others, you get which figure? You get 11.2. 11.2. Or alternatively, the shorter format. There is also a shorter format. The shorter format is only applicable when they have given you the number of the rights of which you are provided. So this question, they gave you the number of the rights. You remember the number of the rights? There are 4 shares. So the 4 shares, you value them at the current market price, which is 12. The 4 shares, we value them at the current market price, which is 12. So when you take 4 shares multiplied by 12, it will give us 48. When you have 4 shares, you get 1 new share. When you have 4 shares, you get 1 new share. That 1 new share, you acquire it at the offer price. Remember the offer price? It was how much? Multiplied by 8. So you just made 8. So this will be a total of 5. This will be a total of how much? 56, like that. So that your theoretical exit price, simply take 56 divided by 5. So we can also apply that portion. When you have the number of the rights, the offer price and the current market price, we just calculate it in that format instead of the other formula. So for this question, because they had given you all this, it was easier to apply this one to give you those figures, to give you those values, to give you the values. So it is giving us the same thing. Yeah. So assuming they also added their Roman letter 4 about value of the rights, I also want us to see how to calculate the value of the rights. We can also check how to get the value of it. So the question did not ask, but I would like us also to include there the Roman letter 4, how to calculate the value of the rights. How to calculate the value of the rights. When you want to compute value of the right, when you want to compute, I've given you 3 formulas. I want us to confirm using the 3 of them. So the first one, value of the right was market price per share minus the theoretical exercise price. Remember, it will be 12 minus your theoretical exercise price from the quarter, which 11.22. Therefore, just then, or alternatively, value of the right will also be given by market price per share minus the offer price divided by number of the rights. Then you add 1 like that. So market price per share is 12. Offer price was 8. Was it 8? Then 4 plus 1. We are just confirming that when the question requires it, you just pick one of the formula. It will give you the same value for the right. Give you the same value of the right. Or also to get the same value of the right, it will be theoretical exercise price minus the offer price, also divided by number of the rights. So theoretical exercise price, I'm told it is 11.2 minus 8 divided by 4. So you only use one of the formula. All of them will give you the same value of the right. All of them will be able to give you the same value of the right. All of them will be able to give you the same value of the right. All of them will be able to give you the same value of the right. So that is now for that question. The next question should be September 2021. September 2021. September 2021. September 2021. There is a question number 3, part B. September 2021. There is a question number 3, part B. September 2021. There is a question number 3, part B. So that question 3, part B for September 2021. They were able to give you details that Hakika Limited is a newly listed company in the local securities exchange. Is a newly listed company in the local securities exchange. So the company has 1 million ordinary shares trading at shillings how much? 49.50 per share. So to finance a restructuring exercise, the company will require 7.855 million. So that's not the amount to raise. To finance the amount, the company intends to issue a 145 right issue at a subscription price of 39. So 39 is the offer price. Then the question has also given you number of the rights. Consider 5 shares. When you have 5 shares, you will get 1 new share. So the number of the rights are 5. Then they continue to say that the finance manager has projected that upon restructuring, the company's annual cash inflows will increase by shillings 965,000. So in the previous financial year, the company paid a dividend of how much per share? 5 dividends, and the company's earnings are expected to grow by 5% annually upon restructuring. So now required Roman letter 1, the price of the share after the right issue, but before they start selling what? X right. So that sentence is meant to mean that the right market price per share. It is the market price per share after the announcement of the right issue, but before the right issue takes place. So that Roman letter 1, they simply want you to compute right market price per share. Roman letter 2, the theoretical X right price per share. The theoretical X right price per share. Then Roman letter 3, the theoretical value of the rights when the shares are selling what? Right. So that's now the question we need to go through. But Roman letter 1, they simply want you to calculate the right market price per share. So because I will not be able to finish the question, I would just want us to write something small, which we can finish within the next 5 minutes, because that one, I will not be able to finish it comprehensively to make it more understood. What I will do, let us just write something small about, we can write that the success of the right issue, the success of the rights issue, the success of the right issue depends on the following. The success of the rights issue, the success of the right issue depends on the following. The success of the right issue depends on the following. Number 1, the current market price per share. Number 1, the current market price per share. Number 1 will be the current market price per share. Number 2 will be the subscription price or the offer price. The subscription price or the offer price. Number 3 will be efficiency of the stock market. Number 3 will be efficiency of the stock market. Then number 4 will be number of the rights required to acquire 1 new share. Number of the rights required to acquire 1 new share. The number of the rights required to acquire 1 new share. So we shall be understanding those terms when we do more other questions in relation to that. Like now, if you can refer to some of the questions in relation to that. If you can refer, the question we attempted December 2021, question 2, part A. December 2021, question number 2, part A. We have just done the part B. So that question 2, part A. That question 2, part A, December 2021. We have just done the part B. Remember, we have just done the part B. When you go to part A of the same question, they said that highlight 2 factors that are likely to affect what? The success of the right issue. The factors that are likely to affect the success of the right issue. There are those 4 points that we have simply explained we just tell them about the current market price per share. So if the price per share is attractive, people will buy the shares of the company. But if they see that the price is not attractive, they will ignore it. Also, we have mentioned about the subscription or the offer price. Also, people will buy the shares if they can be able to afford. The offer price or subscription price will be the buying price. They only buy if they see it is affordable. Then also the stock market should be actually be efficient, or the number of the rights. So that's now on that part of the question. Also, when you check May 2021, also check May 2021, question 4, part A. May 2021, question number 4, part A. You can also check May 2021, May 2021, May 2021, question number 4, part A. You can see that question 4, part A, where they say that outline 4 factors that will hinder the success of what? The right issue. So those are the factors which could hinder the success of the rights issue, which could be able to affect the success of the right issue. So you will be able to check them in that manner. So I want us to stop there so that when now we meet in the next class, we can be able to do that question that I've been able to specify, because it is now exactly some 3 minutes to 1. So we can stop there for now. So we don't have the class in the afternoon. It has been covered now because Mwalimu was not there. So we can stop there. When we meet next week, we shall continue.